Hello, everybody. Happy New Year and welcome to the Enlightened Investor. We're here at the last day of trading in 2022. And this channel continues to be for about a year and a half now, a channel that focuses on economic and financial education. I think we're doing a pretty good job at that.
106 subscribers, you told me. We apologize. We've had a little gap in the action, but it's been busy year end and holidays and all. And we'll sneak this one in for the year end and get ready for 2023.
Yep. So thanks for showing up here today, and hope everyone's doing well and staying safe out there. So this shows today is about our scorecard of our prediction, our kind of whimsical predictions of how things were going to go this year, 2022. And how what's our thoughts on predictions in general, Mike? And how did we end up doing, you think?
I took a look, so I know how we did. But I mean, like we talked pregame here, is like predictions in my realm of being a professional financial advisor are strictly noise, and we're not out there. I mean, we do make long-term forecasts when we're planning for people, and we're conservative in those, but we have a process just for long-term expected returns on asset classes. We don't sit here and say, well, we think we need to be in or out of the market, or in tech and out of industrials or pharmaceuticals, or buy Walmart or all that, because it's noise long term, and you're best to tune it out. But I guess we can make fun of it in light of it, and we'll do our own predictions today. And I think we're going to do another one shortly.
Yeah, we'll do another one
just to predict what we see going forward for 2023.
Yeah, keep showing how excellent we are at predictions, right? Yes. And it's also funny, I think, that a lot of people that when we find out what we know that we do for a living, like I'm an economist and you're a financier, that they say like, hey, what's going to happen this upcoming year, guys? And you're like, well, we don't know, right?
Well, it's unfortunate, but people we talked about this too, is people like certainty, right? I mean, so they manufacture a lot of products around certainty.
That's for sure.
Yeah.
We'll get into some of those products, but so here's what this beginning of January of 2022 we came up with these predictions, and here's from Robert Kiyosaki said a Great Depression and crash is coming. Harvey Dent said the biggest stock market crash of all time is coming, and at the same time, same day, Matt Campbell said the stock market will be up 20% this year. So what a variation that we've had, and what actually ended up happening here is that we had a correction, right? We saw some years of over excess returns, like over 10% rate of return. And we saw some of that kind of come down, like a reversion to the mean, essentially, right?
Especially if you look at like the last decade, the QQQ, which is the ETF that measures the NASDAQ, which is tech stocks. I don't recall, I didn't do the homework before the show, but it's like 20, at one point before the downturn here, it was up, the compounded return for the decade was like 25%. Well above any equity historical mean. And forget if you want to, even taking into consideration the valuation is really high when you looked at growth versus value. If nothing else, if you just get reversion to the historical mean, it makes sense. You're going to see some downside in the stuff that's done really well, and you're going to see upside in the stuff that hasn't done well. And that's what we've seen. Value's now doing better, and growth has gotten
hammered
pretty hard, right?
Yeah. Not just I think everyone out there is listening knows like what happened to Meta, what happened to Apple, what happened to Tesla.
Right.
And it goes, what happened to Amazon? Like, compression 80% sometimes. What happened to Cathie Wood ARK Fund?
Right. That's why you got to be diversified, right?
Diversified, yeah. So anyways, tech stocks, QQ got hammered. The value stocks didn't do quite as bad. They were down maybe 8% this year, something like that. So again, reversion to the mean. And I think what's interesting is like all these people that do prognostications and predictions, how do they end up doing? And there's two things we want to take a look at, two pieces of evidence. First, individual investors, and secondly, how did the pros do? So the first one is, and we find this idea called hindsight bias, where people like give a prediction and they're wrong, but they feel that like their error wasn't as good as bad as they thought it was, right? So,
right. Yeah.
So the Wall Street Journal every year does this. Was it Jason Zweig,
yeah,
right?
He's one of my few that I will follow and read his article. He's in the Wall Street Journal. Highly recommend if anybody does read the Wall Street Journal, you're not familiar with Jason Zweig, follow him. But also he has a very good website. If you're not a subscriber to the Wall Street Journal, he puts out a website on his own too. Jason Zweig, Zweig.
Yeah, he sends me emails all the time on that.
Good columnist.
Yeah. So like, and at the individual level, these Wall Street Journal individuals, they predicted over half of them predicted the stock market would be up 9-10% last year in 2022, and that wasn't the case. And in fact, only about 2 or 3% of individuals said they would be down over 20% or more. So only, really 3%, 2%,
right?
handful of individuals predicted it right. And,
they did better than the pros, though.
Yeah, tell me about the pros here.
We'll have to put that page up and have Ryan put that on there. That shocked me when I saw those numbers.
Yeah, so Oppenheimer had S&P forecast of how much, Mike?
What we got there? 53.30. They were only off
40%.
Almost 40%, so they were close.
Yeah, how'd you like to be a client?
But these are all the big names. I mean, you got Goldman Sachs, J.B. Morgan, Citigroup, UBS, Barclays, Wells Fargo, Bank of America, Morgan Stanley. None of them were even close in the ballpark, but these are the guys that are on CNBC every day telling you this is what the market's going to do, which alludes back to what we led with. It's noise.
It's noise. Well, it makes you want to be a client of Barclays right now.
Right, exactly. Right. What value do you add? I'm a forecaster. You need to be a manager of risk, true risk, and not just a forecaster. Okay.
Okay, so here's how we did. Here's how Mike and I did with our scorecard of predictions for 2022. So we had 7 predictions, and here's the first one. We said that in 2022, a recession would be. This was my analysis.
I think these would be, I was going to say, let's go to these were the economists.
The economist analysis. No blame here for this guy.
I try not to get into any forecasting.
Yeah. So the probability of recession. Yeah, I actually came up with a percentage using like technical Tobit regression analysis of 12.7%.
I like that.
Yeah, I actually gave you a percentage.
Probit model, folks.
Yeah.
Heard it here.
Yeah, I looked at like data from a time series analysis.
Yes,
and
professor.
That's why you're not a professor, Dad.
That's why I'm not a PhD. Thank you.
So we ended up having 2 consecutive quarters of negative GDP growth in the second and third quarter last year.
So you got it right.
Yeah.
Right? That was what happened.
Well, yeah. So anyways, I
Sorry.
Yeah.
I didn't mean to interrupt.
So I'm not sure about that one. We did have a black swan in there with the war and stuff like that. So didn't expect that to happen. So I gave that one a negative. Is that all right, Mike?
That's great.
Okay, so the next one we said that the interest rates were going to be at most about 2.5% this year.
The Fed's fund.
Yeah, the Fed funds were going to raise rates up to 2.5%, and they're at 4.5%.
We got half of it. You're like the pros.
So that's number 2. We got we're 0 for 2.
Don't say we now.
That was your forecast. Yeah. So what actually happened? Look at that. What actually happened, Mike? Look at that.
Yes, for
the
sure.
highest spike in interest rate.
I'm
history.
looking forward to seeing what you predict for the rates next year. That'll be a good one, but that's next video.
And so how do we do on our overall asset class for outlook? And so I'm going to give us not a fail on this one. I'm going to give us a question mark on this one.
Okay.
And that is, we did not actually give a 2022 prediction, but maybe we should do like a 2023 prediction. We gave like a 10-year horizon.
Classes?
Yeah.
There's no way I would ever do that.
Okay, yeah, so I want to do that. Okay, that's fine.
I mean, it's just a disservice. I mean, that's can't.
True.
It's just total noise.
But that's part of the story that we're trying to say today.
Yeah, these numbers you've got here are from Vanguard, where they put out a 10-year projection.
Yeah.
We use a 10-year projections that are close to that, I'm sure, as well. And it's because you can measure, at least predict, longer-term returns with somewhat accuracy. It's impossible year by year. You got to do something. But I guess the thing is rates of returns for equities, especially, which we're looking at here, are very muted for the next decade.
Yes.
But which makes sense when the whole reversion to the mean we said, right? Because the previous decade was pretty good prior to the last
that's
year
right.
here. Yeah.
And that should also translate, folks, into real estate as well.
Right.
Should be down.
Yeah.
So I'm going to give us like a question mark on that one. I'm not going to give us a fail or a positive.
I didn't mean to.
But here's where we did okay. We did okay with inflation. We said that the inflation is going to be well above the Federal Reserve's like target of 2 to 2.5%, well above that, and that's definitely been true. That's been accurate. And we also said that debt, the United States debt momentum, unfortunately, is going to be off the charts, just insane. And we said that it would be $31.4 trillion, and I looked it up last night, Mike, $31.38. So we were close.
We just voted in another 1.7 or 1.8, didn't we? So
what is that called? Ombudsman's 1.7 trillion, incredible. And the last thing we did really well is we predicted that the COVID-19 pandemic would end, and we would call it an endemic. And I think that's been very accurate. We called the Omicron variant a white swan. And that was actually very accurate. So that we got 3 in a row there.
Right. Okay.
And the last one is our lighthearted predictions.
That was my prediction, number one here.
And we got all them wrong on these lighthearted predictions. The first one was like we'd have an open house for all you folks.
We missed it.
Yeah, all the
Sorry.
viewers. To come. Yeah, we'll
We're
have.
going to get it this year.
Yeah, we want you to
2023.
come out and visit us with us. And then Bradley's going to make the NCAA basketball tournament. That didn't happen. And then also, we were trying to reach 500 subscribers, and we didn't quite make it there.
Ooh, that was even worse than the pros. We were at 106, so please subscribe if you'd like to get a little lighthearted view on economic trends in the market.
Yeah, so this is our outcome, Mike. 3 out of 7 positive,
Okay.
3 out of 7 negative, and we had one kind of question mark. But we'll give you guys a forecast of this upcoming year, 2023, and what we think is going to happen. Although, again, it is just noise.
Well, yeah, and I want to end with this because we talked about this. I mean, I think the end, like we always say, we're always saying you got to have a plan. You need to stick with it through thick and thin.
Mm-hmm.
And the last 3 years, I think, is a perfect example of this. I mean, if you look at from 2019 at the end, and we had COVID hit right after that, right? And what we also had, look, during that 3-year time period, we had, the FANG stocks went way up, then they crashed. We had meme stocks way up, then they crashed. We had cryptocurrencies way up, they crashed. Then we had, Russia invade Ukraine. But then if you look at it, December 19 through November 22, and just look at the Russell 3000 index, which is a broad measure of the U.S. stock index, it averaged 10%. And that's like its historical return through all the bad stuff.
Thick and thin.
And I can't tell you how many people I've had conversations with that aren't clients, but people that when they find out what I do, they want to talk about the market or maybe what they're doing. And a number of people made drastic decisions to get out of the market due to a number of different things through this whole period, whether it was political or whether it was the pandemic, et cetera, or now the inflation rates and there was pending recession coming or that we're probably already in. And if you just stuck the course, you got the historical return for equities.
Yep.
I'm not saying everybody should be 100% equities, by the way. I'm just saying that's the
Sure.
measure for the equity market.
Yeah,
so
sure.
the end is it's always, we keep telling this, but stick with the plan. Have a plan.
Yeah, and I think also
Monitor it and look at it every year.
Yeah, I mean, I think stick with the plan that is academically based. That's the key. And
Evidence-driven investing.
Evidence-driven, and don't gamble, right? I
Right.
mean, if you're going to gamble, go to Las Vegas.
Well, take 5% of your. I mean, I tell
Or
people
if you wanna have
because
fun.
some people want to have fun. They do.
Yeah.
They want to buy Tesla, things like that.
Yeah,
right?
who's that guy?
Take 5% of your money, have fun, but if you have success, don't think you're a pro.
Right. That's almost the
'Cause
worst
it
thing
could
can
be
happen
luck.
to you, right?
Right. Yeah. Well, so happy New Year's, everybody! All the best to you in 22, and here's the 2023.
Yep. Take care, folks. Light Investor Team, sign off.